there was really three key things or items I wanted to talk about today. The most important of which is the battle for $2,000 gold. Obviously, referring to US dollar prices, and it's a level we've been trading at previous times. We're sort of pretty close to it right now. Ultimately, what I'll highlight when looking at some of the market data and the difference between where we are today and previous environments where we've traded near this price level, I think when we look at all the data, we're going to come away with a relatively optimistic outlook, both for gold, the end product itself, which is obviously what we sell at ABC Bullion, alongside other precious metals, but also I think for some of the more successful mining companies as well, who are obviously leveraged to the gold price. But to get started, or to just touch on a couple of points before I get into that element of the talk, I just wanted to sort of share a couple of insights as well around investor behaviour in Australia. And obviously, being the largest bullion dealer in Australia with operations really all up and down the East Coast and over in Perth, we obviously have a really good insight into what clients are doing and the kinds of things that are becoming more important in the bullion industry. So I think I'll start there. And then I'll move on to a little bit about the Australian case for gold, which I think is obviously incredibly relevant for investors in the room today. And then I'll get onto this last part of the talk. So there's 3 or 4 key things that we're seeing in our client base, and I suspect it's replicated across the bullion industry in terms of the demand for precious metals in this country. So the first and foremost is really the continued and indeed growing importance of gold and other precious metals as a retirement asset inside superannuation portfolios, most concretely evidenced through the growth of self-managed super fund investment into bullion. That's no great surprise. Obviously, anyone that's working in the country is forced to contribute. I think it's just over 11% now into super, and the SMSF market is the largest individual component of the superannuation market, with I think it's just over $800 billion of assets under management across roughly 1.1 million trustees up and down and across the nation. And in terms of what we see at ABC Bullion in terms of the investment values from that segment of the investment community, typically the allocations are around $150,000 to $300,000, sort of somewhere between there. We've done surveys of our database where typically they've come back, where we sort of asked, roughly what percentage of your portfolio you're holding in precious metals, and typically the answer, or the most common answer, is between 10 and 25%, and that kind of aligns with what the investment numbers are showing and what the average SMSF balances in the country are. So it's very clear that there are more and more people every day turning to gold as a diversifier, as a source of liquidity, as a source of returns in its own right, and obviously, last but by no means least, a form of inflation protection, which is something that's come back to the fore really for the first time in decades since COVID hit and indeed in its aftermath. The other thing that we're seeing is the continued popularity and growth of products like our ABC Bullion Gold Saver, which we launched just over 7 years ago now. That's really a sort of entry-level product. People can use it from as little as $50 a month and basically give us the authority via our banking partner to take whatever that predetermined amount of money is, and we will buy the equivalent amount of gold or silver on the day that the client has agreed to give us the funds. We've had more than $60 million saved in that product since it was launched. And by and large, savers using that product have been very well rewarded because the gold price in Aussie dollar terms is up about 50% since then, so far more rewarding than leaving money in let's say an at-call bank account. And last but not least, we've seen really strong support for in-store bullion buying as well. So whilst there's digital channels for people to engage with 24/7, phone-based trading, all of those things that are becoming more popular, not just for bullion investing, but investing, banking, wealth management in general, I think it's safe to say that, particularly given the nature of the asset, there will always be demand for in-store bullion, the ability to engage with the products. And that's been most clearly expressed since we moved into our flagship store at Martin Place, which we did on the 20th of March, which was the day the gold price hit $3,000 an ounce for the first time. If we look at year-on-year in-store bullion sales, they've grown by about 35% across the business, so pretty much the fastest growing channel for us, and it's been a nice validation of the way that we're bringing precious metals to the Australian investment community, and we're obviously very thankful for our clients for supporting us on that journey. So moving on from, I suppose, investor insights in Australia, I think one of the key things, and obviously I'll spend a bit the majority of the last part of my talk referencing the US dollar price, but the Aussie case for gold, as it were, is critically important. On the news at night we hear about the gold price, it's always in US dollar terms. People are always talking about what the Fed's doing, where the US spot price is, et cetera, et cetera. But for Australia, I think we've got this really blessed scenario in terms of investing in precious metals and the reason why you would do it, which is typically around wealth protection, insurance, et cetera. And that is because environments where risk assets tend to suffer and gold tends to do well also happen to be environments where commodity currencies like the Aussie tend to fall. And so what you'll find if you look at market history, and I'll explain this chart in a second, but what you'll find is in environments where equities and other risk assets tend to do poorly, gold in US dollars tends to do very well, gold in Australian dollars tends to do even better. And again, this chart sort of helps flesh that out. The sort of reddish, purplish lines on the chart are the returns on gold in periods where equity markets have fallen substantially. Really all the main events or risk events of the last 20 plus years, going back to the dot-com bust through to September 11, the GFC, COVID, et cetera, et cetera. And you can see pretty clearly that with the exception of the dot-com bust, US dollar gold went up every time. Average return was around 10% across all of those periods. If you look at the Australian dollar gold price, it went up every time and the average return was 20%. So basically double the bang for your buck, and the difference is purely driven by the weakness in the currency. So if you sort of, and obviously forecasting is always fraught with risk, but if we think we're in an environment where, where there's a rising chance of a global recession and inverted yield curves and the like would tend to suggest there's a very good chance that'll play out, then you've got to at least sort of think there's a good chance the Aussie will fall further, and that really just sort of reinforces the case for holding gold in an Australian investor's portfolio. And that brings me on to the last part of the talk, which is this battle for $2,000 gold. And really what I'm going to communicate over the sort of final 6 or 7 minutes that I have is that whilst the gold price is trading at a very similar level to what it's been at in the past, the market environment couldn't be more different. And the first way of illustrating that is actually just around investor engagement and news flow to do with precious metals. So the chart that we're looking at now, the white columns that you can see, it's data sourced from Bloomberg, and it's a very, very simple story count per month going all the way back to 2013, the number of stories that just mention gold, right? And the red line is the US dollar spot price over that time period. So it shows it sort of bottoming out in 2015, rocketing up to $2,000 and so on and so forth. And if you look back to 2013, there were roughly 90,000 stories a month mentioning gold. In 2020, when it hit the all-time high in August, you had just over 100,000 stories in a month. That got replicated again at the start of last year when Russia-Ukraine sort of kicked off in earnest, sadly. But if you look at where we are now, this number's completely fallen off a cliff. So when we talk about, and obviously this community here, and events like this are an exception, but when we talk about the broader investment community and what people are talking about, gold is kind of off the radar now, which is, I would say, and I've had now, on my 26th year in financial markets, that is almost a precondition for a bull market, right? You need to have, for want of a better term, apathy across the broader investment community. Gold did not tick that box in 2013 or even a couple of years ago, but it does now. So I think that's the first good sign. Next chart, and this will just help me then get into the next points, just sort of shows the gold price a little bit more clearly without all that noise of the columns that were there, and it also goes all the way back to 1999, so it's a little bit longer, and it just put, you can see there with the red dots, you can see the 4 points where gold has sort of kissed or briefly traded above $2,000 an ounce. And I'm really just going to talk about where we are now versus 2011. I could talk through every environment, but I'd be telling the same story 4 times, so that'll get boring for everyone pretty quickly. So if we just look at what's different between now and say 2011, there are several things that really stand out. The first and perhaps most obvious one is just performance and performance momentum. So if we go back to 2011, the 10-year return for gold leading into that price peak, it had rallied just over 450%, basically gone up 10 years in a row in US dollar terms. For silver, I haven't got it on the slide, but for silver, that number was 1,000%, right? That's how much it had gone up in the 10 years to 2011. This time around, in the 10 years to August 2023, gold in US dollar terms is only up by 40%. Silver is basically flat. In US dollar terms, it's gone nowhere. That's just precious metal prices. And actually, incidentally, sorry, I should add to that, 10 years ago or 11 years ago, the gold-silver ratio was at 30 to 1. Now it's basically at 80 to 1. So again, a very different scenario. But as I said before, it's not just about gold, it's about its engagement and interaction with risk assets, most notably equity. So in the 10 years to 2011, for that entire decade, the S&P 500 only rose by 9%. This time around, it's up by 176%. Valuations have gone from 20 to 31 at last check. So equity markets have been far more rewarding. They're also far more risky today than what they were back in 2011, just over 10 years ago. That's what the prices alone tell you, but it's more than that. If you look at the financial market drivers, and there are 2 primary financial market drivers outside of equity markets for gold in US dollars, it's the US dollar index itself, and it's what happens with real yields on treasuries. And again, if we look at the 10-year treasury, in the 2 years leading into that 2011 top for gold, it had fallen by 158 basis points, lowering the opportunity cost of gold, making it more attractive to hold. This time around, that yield has risen by almost 3% in the last 2 years. And then same dynamics at play with the dollar index. It was in a 10-year bear market where it lost over 30% of its value into 2011. Over the last 10 years, it's rallied by 25%. So again, very different scenario. The ETF and futures market are also really interesting in terms of the data and what that tells us. So in the 2 years to 2011, there was almost 700 tonnes worth of metal flowed into ETFs globally, predominantly in the United States and in Europe. Those are the 2 biggest markets for gold ETF investment. In the last 2 years, 200 tonnes have come out of those products. So not only is there no price support coming from that part of the market now, that part of the market's actually contributing downward pressure. But gold is still near $1,900 or trading above $1,900 an ounce. And ditto for the futures market, where back in 2011, the net position for managed money speculators, people basically betting whether the gold price is going to go up or down, was just over 200,000 contracts back then, which in dollar terms at a $1,900 gold price is about $40 billion. That number up to 2 weeks ago had dropped to 30,000. I haven't updated this table since, but I had a quick scan. I think the numbers actually dropped to 9,000 as at the last reading. So all of that speculative froth is now completely gone from the gold market today. And last but I would say not least, just in terms of a gauge of retail or investor sentiment, every year in the United States, Gallup do I think it's a fantastic survey where they basically ask Americans, what do you think the best long-term investment is? And they give them a handful of options: stocks, bonds, cash, real estate, and gold makes the list as well. Back in 2011, 34% of investors chose gold, right? The number of investors that chose stocks and real estate combined, so combining 2 assets, was only 38%. Because the scars of the global financial crisis and the property crash that they saw in the United States was still so profound that most people wanted this great safe haven asset, which had been in a 10-year bull market. That's gold. Not so many people were encouraged to own stocks and real estate. There was still a lot of concern. When that survey was done this year, gold was still popular enough. It got a quarter of the votes, but the number of people that were convinced that they should have their money in stocks and real estate was 52%. So it was basically double the number that favoured gold. So if you add all these things up together, and my time's basically up, so I'll take one more minute. Back in 2011, Gold needed everything going for it in order to get up to near $2,000 an ounce. It needed a 10-year bull market. It needed to be outperforming risk assets. It needed to be incredibly popular amongst investors. It needed huge speculative inflows, and it needed money coming in from the ETF sector. Those were all the requirements to get it up to that level. This time around, despite all of the challenges from outflows from ETFs, abandonment of speculative positioning, relative investor apathy, again, this sort of audience notwithstanding, the gold price is still near $2,000 an ounce. Now, all of these things are just part of the market cycle. They're never always going to be bullish. They're never always going to be bearish for gold and indeed for other assets. So I suspect that in the years to come, the majority of these current challenges are going to again turn into tailwinds for precious metals, such that a few years from now, we are going to look back and say the $2,000 gold price, rather than being a ceiling, will probably end up looking like a floor. Thank you very much for your time.